The global environment may be uncertain, but the past 3 months have been kind to the corporate sector. New figures show gross operating profits climbed nearly 19% in the June quarter, the biggest rise in a decade. The corporate reporting season, which is drawing to a close, was less spectacular, with good news balancing out the bad. Here's Philip Lasker.
Amid the talk of double-dip recessions, corporate Australia is bracing for bad times that haven't arrived. The growth drivers are still driving.
A lot of those growth drivers, particularly profits and incomes and exports, performed quite strongly in the first half of the year, and it's likely to drive growth up quite strongly through the rest of 2010 and into 2011.
But mining is the biggest driver. Company profits rose 18.9% in the June quarter and nearly 30% for the year. But without mining, the rise was a much more moderate 3%, and inventories fell slightly. The top three sectors were mining, where profits soared more than 60%, construction and financial services. So analysts now think Wednesday's June quarter GDP number will be double the previous quarter.
We think the result will be very strong, up 1.1% in a quarter to be up 3% over the year.
Some of that was reflected during the corporate reporting season, but it wasn't all good news.
In terms of companies reporting positive and negative surprises, it actually ended up as a draw.
On an earnings per share basis, just as many company results came in above expectations as below, with 55 in line. The cautious banks and telcos, particularly Telstra, were among the biggest disappointments in terms of results and trading updates.
But outside of those two sectors, most sectors delivered quite good numbers.
Quite a positive story has come through the dividend front. Companies have generally reported robust dividend streams. And indeed, we've started to see clear evidence, including with Woolworths, that companies have got excess franking credits that they want to give back to shareholders. So we've actually seen very clear evidence that Australian corporates in general are enjoying strong cash flow on the back of very robust balance sheet.
It hasn't stopped UBS shaving its 2011 financial year earnings forecast by just over 1% and more outside the mining sector.
I think there's certainly plenty of capacity there in terms of the balance sheet from either an M&A or a capital management perspective. But at the moment, I think companies are inherently cautious given that global and to some extent domestic conditions are still reasonably uncertain.
What is expected is the big resources sector payoff this financial year.
Earnings growth for FY11 is expected to be about 19%, but excluding resources it's more like 9 or 10.
And as for hung parliaments,
it's more of marginal interest because it hasn't been seen before rather than of fundamental interest.
Investors will be thankful for that.